Becoming a millionaire is a major milestone in investing both psychologically and monetarily. And in this video, I'm going to show you the method to track your progress to reaching millionaire status before the age of 40 or whatever age that you may be shooting for. And throughout this video, I'm going to break down each step so that if you're not on track, you know exactly what adjustments you need to make to start getting on track. Now, there are only 4 variables that determine whether you hit millionaire status or not. So let's start with these 4 variables and understanding what they are. Our first variable we'll call PV. This is the present value or the current status of our portfolio. How much money are we starting out with? The next variable that we have is PMT, or also known as payment. And this variable is how much annual additional contributions we are making to the portfolio. Annual contributions right here. Our next variable is going to be variable R. R is our rate of return. What is the average return that we're getting every single year in our portfolio? Rate of return. And our last variable is variable N, and this is the amount of years that we have left until we reach our age of 40. So number of years. Now, the first step in this process is determining how much time that we have left. Due to compounding, time is an important factor in us reaching our goal. So for our N number, we want to subtract our current age from the age of 40. So let's say right now that you're the age of 30, we're going to take 40 minus 30 equals 10, and that's going to be our N number. Next, we're going to get our current portfolio. Now, our current portfolio, our variable right here, PV, is going to be our current net worth. How much progress have we made thus far to reaching millionaire status? Now, if you don't know how to find your current net worth, how we do this is we take our assets. This is the amount of assets that we own. This includes our real estate, any type of retirement accounts, and then we subtract them from our current liabilities. This is the amount of debt that we owe. And this gives us our current portfolio, PV, also known as our net worth. Right. And let's say in this example that at 30 years old, we have a net worth of $250,000 total. Then we're going to find our rate of return. Now, what our rate of return is going to be is our average return that we have gotten annually, or we can take the historical averages on what the market averages. So if you look up investing in the stock market, that's where most investors are going to start, either in stocks or real estate. The average return is going to be anywhere from 8 to 9% for stocks, or it's going to be anywhere from 3 to 4% in real estate. Now, if you want to get a more accurate representation of what your annual return has been, you can look at your old statements or track your net worth throughout the years, and then just simply subtract what it was at the beginning of the year from the end of the year and then get the return. So let's say I started the year with a $200,000 net worth, and then at the end of the year I had $250,000. So we'll put that right here, 250K minus, excuse me, I can't write today. This is going to add to a 50K gain for the year. And then I can calculate this for the annual return by going 50,000 divided by my starting amount of 200,000, and then this would equal a 25% return. Not bad, right? If we had a 25% return. But if you want a more accurate representation, you can do this. I like to just use the average market returns because it's much easier and straight to the point. Now, the last variable is going to be our PMT. And our PMT is our annual contribution. So you want to know how much are you investing every single year. If you don't know this number, you can look at old pay stubs or W-2 tax return statements to see how much you're contributing to your retirement account, or calculate how much you're contributing to outside investments outside of your accounts if you have a monthly or annual recurring savings rate. As a rule of thumb, at a minimum, you should be saving about 10% of your salary. So in this case, we'll just make it easy and say that we're saving about $20,000 per year in contributions to investments, and this is going to be our PMT. So to make this really easy, I'm going to list these out. We had our N was 10 years. We had our present value of our portfolio was $250,000, and we're going to call our R our rate of return. let's just go with 8% annually. So now that we have these four variables, we need to look at the formula and how we can calculate what our status is going to be at the age of 40 and then make any necessary adjustments as needed to get to the millionaire status. Now to calculate this, we have what's called a future value calculation. Now I'm going to write out the exact formula for you and then I'll show you an easy way to calculate this so you're not bogged down with algebraic math. So a future value calculation is calculated like this. We have future value equals the present value times 1 plus our rate of return raised by the number of years that we have left plus our annual contributions. Let's zoom this out a little bit. Multiplied 1 plus the rate of return raised by the number of years minus 1 over the rate of return. Holy crap, a lot of math going on right here, right? But it's important for us to understand how this formula is laid out because this is going to help us make the necessary adjustments so that we can reach our financial goals. Now, when we look at this formula, since we have all four of the variables, we can plug and play this into a calculator, or you can just simply plug them in and use AI to your advantage and have it calculate this for you. Now, if you're doing this exercise for the very first time and you currently don't have an investment plan or a clear path to get to $1 million in net worth by the age of 40, this is exactly what I built the investment blueprint for. You can visit the link that's going to be in the description. The investment blueprint is going to help you outline and visualize and plot out what you want your future to look like and how much money it's going to take to get there. By the end of it, you'll have a printable document that has a plan and a blueprint that you can use for reaching your financial number. So you can grab this completely for free at www.financewithsantiago.com/blueprint. So here we have outlined in ChatGPT our four variables, and I have put as the prompt, I'm calculating a future value calculation for my portfolio with the following variables. We listed them out. I want to know how much money I will have by the age of 40 if I'm 30 years old right now. And then let's see what AI gives us. Okay, so we see after it runs the prompt, it says that our future portfolio, if we continued on this same trajectory, is going to be $829,000. And this is pretty good, but it's a little bit short of us reaching our $1 million goal by the age of 40. So what are the things that we have control over that we can change? If we go back here to our four variables, the two variables that are going to be the easiest to change is our contribution amount and also our rate of return. We can take more risk to get a higher potential rate of return. We cannot change time. What we can do is change the length of our goal. Maybe we extend our goal from 40 to 45. But if we want to keep that goal at being a millionaire by 40, our time is fixed. We can change the amount we contribute. We can change our rate of return, and we can't change what our current portfolio is right now. So more often than not, what I see is investors at a very young age taking not enough risk to reach their potential financial goals. And what I mean by this is that if you are in your 20s or early 30s and you're thinking long term, you want to get a healthy return for the amount of time that you have. The more time that you have, the more time that you have for the market to play out and fluctuate up and down. I have seen portfolios where you have somebody that's 29 years old and half of their portfolio is in bonds, getting them a 3 to 4% return, when in the long run, they would be much better off taking market risk and getting a higher rate of return because they have plenty of time to let the market play out. So if you find yourself that you are under your goal when you run this calculation, one thing to consider is adjusting the amount of portfolio risk that you take so that you can get a higher rate of long-term return, or you can look at your finances and see if you can contribute more, because the more money that you put into the market, then the more it allows it to compound and multiply over the long run. So when we're thinking through this exercise, this might mean savings more, but it could also mean building skills that allow you to earn more money if you're finding it hard to save more money. Earning potential plays into this as well, because the more money that you earn, the more money that you can invest. Now let's go back to the AI and change two little variables and see how this affects our results. So what we're going to do is we're going to change the rate of return to 9% instead, and we're going to put the annual contribution at 30,000. So we're going to increase by 10,000 and see what our results get us. So we see here by making those small two little changes, just getting an extra 1% in return and contributing an extra $10,000 per year, we get to our $1 million before the age of 40. But notice that 1% return and just $10,000 extra dollars per year changed the results by over $100,000. So when you are looking at your portfolio, I highly encourage you to go find out what your current rate of return is, find out what you're invested in, and see if you are taking enough market risk to reach your future investment goals. Maybe you're not taking enough risk to make a meaningful difference in your portfolio for what you're expecting in the future. So each year we can use this formula to check in and see what adjustments need to be made for our annual contributions to make sure we reach our goal of having $1 million net worth by the age of 40. So now that you've learned how to track whether you're quietly on pace to becoming a millionaire by the age of 40, there's one issue that trips up a lot of people even when the math says that they're on track to reach this goal. And it's keeping too much cash sitting in a savings account that isn't getting a high enough rate of return. So if that's you, what I want you to do is check out my next video where I show you exactly what professional investors do with their cash so you can get a higher rate of return and reach your goals faster.